Hi everyone, it's Alex here at Sestry Capital Research. Welcome to our Growth Investor Pro webinar for Thursday, the 14th of September. It's currently 5 o'clock Eastern for the benefit of the tape. Okay, so today I want to cover a number of topics. Let's just take a quick look at the S&P and the NASDAQ and see where they are on the larger and the smaller degree. And let's in particular take a look at a more bullish case for both than we've been considering. We've sort of hinted at this in recent weeks, but I would say there's an increasing possibility that we have more upside than previously modeled. That's only a bull case. It's not something we're settling on. We don't have to decide yet. Doesn't affect any decisions at this point, but let's take a look at it, what it might look like. Adobe printed their quarter today after the close. Pretty muted stock price reaction, but fundamentals are good. Stock looks like it can run up further medium term, so let's take a look at that one. And we haven't checked in on the uranium ETFs we cover in some time, but they're starting to move up nicely through our markup zone. So let's take a look at that. And then a couple of things that are coming soon to the service we'll talk about, and just a reminder of some features in the service that are not particularly well used to look at as well. As always, we'll operate Q&A all the way through the session. So if you have any burning questions, points, things you agree with, disagree with, anything you want to say at all, questions you want to ask at all, then either unmute yourself and shout into the system, or you can use the chat room. Now, Adam's saying you can't hear anything. Can other people hear stuff? Let me just check Adam in chat. Hold on. I'm going to assume they can until I'm told otherwise. I don't think I'm on mute. Seems to be okay on my end. Anyone else got any problems? Yeah, okay. I think it's just you, Adam. Do you want to try logging out and back in again? Okay. All right, so let's do our usual disclaimer. Let's go. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis of the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Sestry Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestry Capital Research. Sestry Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so back to our agenda. Let's do an index review first. Let's look at the S&P and the NASDAQ. So let's get those on the screen right now. Okay, so let's start with the S&P. Now we don't need to rehash this. We've covered this many times in recent weeks, but in essence, our base case chart model, call it what you will, which we've been using this chart for a couple of years now to pretty good effect. This says we're in a wave 5 up, and for those of you unfamiliar with the Elliott wave system, there's many technical analysis methods that work. I don't think any one of them is particularly godlike. This is just one that we like and has proved useful for us. But in this particular method, that fifth wave up is usually the last wave up in a cycle. The cycle being this a longer move of 1, 2, 3, 4, 5 waves up, being a large degree single wave up. And at the end of a wave 5, you can typically expect the stock to roll over and start to sell down pretty hard. The reason that we thought this is a wave 5 is in essence because of where we start the chart. So it's off the screen here, but this chart starts at the 2015 and 2016 lows, and the reason it starts there is because you can define a pretty good wave 2 down into the COVID spike lows based on a deep Fibonacci retracement if you start way back there. And I'm not sure it's textbook, but what we found in our work is that if you define your wave 2 that way, and therefore your wave 1, you can then define your wave 3 pretty accurately, and then a 4 and a 5. And I don't know if you could teach that in chart school anywhere, but it's a method that's worked for us pretty well in multiple time frames in many different securities. And so on that basis, This is wave 5. It does follow a 5-wave pattern quite nicely. You've got a deep wave 2, a sharp drop into a deep wave 2, and a seemingly unstoppable wave 3 up, and it certainly felt like that in 2020, 2021. A rollover at a 1.6 wave 3 extension, textbook, and then a drop. Although it was a deep wave 4, it didn't retest or break through that wave 1 high. And so that's a righteous wave 4. It's a deep one, but that's because it's a big wave 3. So that's a righteous wave 4. Ergo wave 5 next. And the Nasdaq, if we just look at that very briefly, it looks pretty similar. There's faster movement in the Nasdaq, and the amplitude of the waves is usually higher. But what we've been tracking is basically this path here from the December 18 lows. We've been saying 1, 2, 3, 4, 5, and that 5 ought to finish. Let's just lose that for a moment. Somewhere in the 440s, 450s, 460s probably. So you've got the S&P and the QQQ quite close to all-time highs now. Let's go back to the S&P. And this chart says, okay, there's some upside to go, but then there's a rollover quite soon and probably a dramatic sell-off. So the question is that right? I mean, certainly that's technically what the chart shows, and very often charts reveal reality before we know them ourselves. And the reason for that is that the folks that are buying and selling securities to actually moving markets know a lot more than does the average investor. And I'm not talking about a billion, even $10 billion hedge funds here. I'm talking about truly big money that spends its time in and out of the corridors of power. That's their job, and so they have a much better estimation of should they be buying or selling shares than most other market participants. And for that reason, stock charts usually can forecast reality a bit better than reality can forecast stock charts, because what's being priced in here is the actions of folks who have a bit more of a window, more of a timeline into the future than do normal people. They don't watch the news, they make the news. So on the one hand, you'd say, well, okay, the technical pattern fits. We're going to hit a wave 5. We're going to roll over, and that is, the much vaunted recession, or there's going to be, some macro event, China, Taiwan, or something grisly in US politics, or something, right, to cause that to roll over. And of course, that could happen. What you have to ask yourself, though, is that likely to happen? And if you look at reality right now, if you look at any measure of the US economy, it's in really, really good shape. GDP growth is strong. Inflation's coming down. I know it ticked up a bit yesterday, and PPI was up a bit today, but it's a bit. It's small beer, and the market's lapped it up. Now today's market was bright green. Yesterday, muted reaction. You can say in today's market there's options expiry effects. I'm sure that's right. But net, CPI and PPI just came in a bit higher than expected, and the market just kept moving up. That wouldn't have happened last year. In 2022, market would have dumped on higher than expected inflation. Jobs pretty good in the US, and then if you get down into the weeds, look at the earnings reports that we keep pushing out in this service. Okay, the biggest companies out there that we cover are showing improving earnings. If we just very briefly look at Adobe, and we'll obviously come into this in more detail later on, but just look at the top line here. Forget earnings, forget cash flow, forget any of that. Just look at revenue. So Adobe, which I remind you, serves creative industries. These are industries that are quite badly affected by swings in GDP. Growth peaks at 26% in February 21, comes down pretty hard. 22, we've got a 9% growth quarter. And then throughout 2022, it's not that bad, but look what started to happen, right? So growth troughs at 9% in the February 23 quarter. It ticks up last quarter to 10%, 10% again this quarter. That's a beat. It was supposed to be 9%. And they're forecasting 10% for next quarter, and probably they'll beat that by a point. trailing 12-month revenue. And again, we're going to come back to this in more detail later on, but this is really good evidence for, well, can the economy really be that bad? You've got a business with a, pretty much a $20 billion annual revenue number, growing its revenue at 10%. And that rate of growth has flattened out and might start to pick up. If you were to look at Microsoft, you'd see a $200 billion annual revenue business where growth troughed at 2%, I think 2 quarters ago, and has since picked up to 7-8% and beyond. And most likely, I think it's going to accelerate beyond that. So you have huge companies like Microsoft, and you have companies that are fairly exposed to the economy like Adobe, that are not only doing well, but growth is accelerating. And that tells you that corporate spend is accelerating. And that tells you that managers are feeling optimistic about their businesses. So none of that feels like the economy is about to roll over. Macro events, who knows? China, Taiwan, Europe via Ukraine really kicks off. These things could all happen. But that's purely speculation at the moment. And I think there is a good chance to say that actually these charts we've been doing are wrong. And they're wrong because the start point is wrong. Now, again, this is our base case. What you're looking at here is base case. This is our expectation. And frankly, if it's a more bullish case than this, it doesn't matter. Right? We don't have to make any decisions yet. This thing, if we're right, and we should be more bullish, then this thing will just keep going up. And once we approach where a wave 5 high should be, which for the S&P should be somewhere between, I call it 495 and 535, that's 61.8 to 78.6 extension of the wave 1 to 3 combined. We'll know if this is a wave 5 high, because if it is, it will roll over and start to sell off, somewhere in this box, maybe a bit above, maybe a bit below, but this sort of range, and we'll know it. We called it in 2021 when this wave 3 high hit. It was obvious, right? It couldn't push up to this wave 3 high. 22 was a bit rougher than we expected by 1 with 1.5 fib levels, but this wave 3 high, we called pretty accurately. And we also called this wave 2 low back in the service pretty accurately, because look, they're V-shaped rollovers. And finally, when the bottom came in 22, we called this as well. Calling the reversals isn't all that hard because they're right there to see. And the trick is, if you're wrong, being able to reverse course, do something about it. But if this is a wave 5 high, we'll see it and we'll call it. But if it keeps pushing on up here, then it's not a wave 5. We're in a wave 3. So like this. So let's just remove. We use the S&P here. The Nasdaq is the same argument, but let's just do it on the S&P. So let's remove all stuff from this chart. We'll start again. So let's say, in fact, that we have the S&P wrong. And let's say the reason we have it wrong is because actually the start point should be the COVID low. And let's think about reality. Why would the COVID low be the start point? Well, a lot of stuff changed, right? People still aren't really going to the office to work, and not just people who have, compromised immune systems or, cancer therapy or, all the reasons to be very careful about COVID. People who don't have any specific COVID risk aren't really very keen to go to the office. And that tells you that it probably isn't, in their minds at least, a COVID thing. It could be worried about long COVID, it could be lots of things, but it marks a sort of behavior change in the workplace. That's led to an acceleration in technology development, technology spending. One of the reasons you see so much progress in distributed application hosting, distributed security solutions right now is the enterprise is becoming more distributed than it had ever planned to be. And that's partly a trend that was happening anyway, but it was massively accelerated by COVID. The big efforts to drag people back to the office are not having too much success so far. So something changed in the world of work. In monetary policy, obviously things changed at the COVID low. So there was some loosening into 2019. Big worries hit the market, and then, as we know, a flood of federal liquidity hit the market starting March 2020, and that liquidity spigot started to be turned off at the end of 2021. So this wave here, from the COVID low to the 2021 high, is a righteous wave, and it might be a righteous wave 1 because everything changed down here with basically the federal spigot getting turned on, and everything changed up here with the spigot being turned off. So I think we can say, well, that's a real wave. So let's call that a wave 1. And what that mean? That must mean that this down here must be a wave 2, right? So let's finish that there for now. And let's measure it. And let's say, well, could that be a viable wave 2? You can't just invent these things. There is a system here. It's open to interpretation. But if it's a wave 2, it has to satisfy some characteristics of being a wave 2. It has to be enough of a self. So the question is it? And my answer is just about. On the NASDAQ, if you were to look at this, let's flip to the NASDAQ. And let's delete this. And let's do the same thing with the QQQ as we just did with the S&P. Just going to remove the fibs on this. Okay, so here's your COVID low, here's your 2021 high, and there's your wave 2 low. That must be a wave 2 low if that's a wave 1, right? So let's measure that. So is that enough of a wave 2? Well, yeah, look, it's a 61.8 retrace. Okay, so maybe we have something here. In the NASDAQ, we have a wave 2 retrace off of the COVID lows down to the 61.8 retracement. And not only that, it's a really good wave 2 bottoming out process. Look, it tests it here, 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 right? So that looks actually pretty good. Let's look at the S&P. A bit less convincing, I would say, because it's only a 0.5 retrace. And I personally like to see a really deep wave 2 to convince me it's a wave 2. But a 0.5 retrace can be a wave 2 under the, let's call it rules. Okay, so if that's the case, well, where next? And the answer is, well, we can project where next. So let's get our fib measuring tool out. Remember, all these Fibonacci levels do is they're measuring tools. They measure amplitudes of waves. That's all they do, not rocket science. So let's see where the wave 3 might end, if this is indeed a wave 3. Now, wave 3s, you'll know, can be pretty dramatic. Minimum length of a wave 3, it has to at least exceed the wave 1 high. So we can assume it does that. More common is 100% extension. So if this is a wave 3, then let's just draw that again. We should see the S&P go to the SPY go to at least 611. But as you also know, it's pretty common, even in indices, for the 1.618 extension to apply. So it's possible, and I'm not saying this is going to happen, and I'm not saying this is our expectation. It's possible that we could see something like that. In other words, a big move up in the S&P from the October 22 lows, a multi-year move up to this sort of high, and then a big drop. And the wave 4 low would probably end up down back in the 480 level, back to this wave 1 high, something like that. So perhaps what we're seeing, because if you think about it, market feels exceptionally bullish right now. Most stocks that you look at feel like they want to go up. Medium term, of course, anything can happen day to day. And the move up from the lows in 22 and through 23 has surprised most people to the upside. It won't have surprised you if you've been a subscriber here for a while. We've been saying the same thing for some time, but it's surprised lots of the market. And it feels like a wave 3. It feels like it's unstoppable. And so if that's the case, then the rollover when it comes will also feel pretty brutal. A wave 4 down off of a big wave 3 like this will feel pretty brutal. And so look at the QQQ. Do the same exercise. Let's do our fib extensions. So we'll just redraw that. So the COVID lows, 2021 highs, 22 lows. So yeah, minimum wave 3, right? 411, just above the prior wave 1 high, but that's not a common wave 3. More common, 100% extension, so that's 500 for the sake of argument for the QQQ, and more common still is the 1.618 extension, which puts the QQQ up at 650. Now, if you go around in the street now saying QQQ 650, people would just laugh at you. There's no point doing it. But I remind you of many stocks, which at the start of the year, let's pick the obvious one, Nvidia, right? Everyone knows this, but at the start of the year, we haven't messed with this chart at all. Go back, look at the chart we were posting in late 22. It's all on public articles all over Seeking Alpha. We said accumulate between 100 and 150, wave 3 up for this very volatile stock can take Nvidia to 620, right? Well, it may not get there. It might roll over now. This look, you can see it's hit the 1.236 extension in the wave 3 and so far hasn't climbed above that. So maybe it rolls over here. I don't know. But if you'd run around, telling people when Nvidia was in the hundreds that it was going to make 500 within the space of a year, everyone would have laughed at you. And that's the point about wave 3. Is they surprise you about how fast they are. First of all, how quickly they move up. So how far they move up, I'm sorry, and then how quickly they move up. Marvell, I mean, you know all this, right? But again, sleepy old hard disk controller stock as was. We'd said accumulate between 33 and 45. Thank you, Fred Frog, for this one. This wasn't our idea. This was Fred. Thank you. Doubles overnight. MongoDB. Again, this is not a new chart. This is our old chart. Accumulate between 126 and 223. So far peaked at 440. So even from the top of the accumulate zone, it was a double in no time at all. Why is that? Well, you can talk about AI all day long, but the real reason is it's in a wave 3 up. So you can't say, oh, great, I'm just going to set course for the QQQ to hit the 600s and go on vacation. Life's not like that. But it's possible. It's just possible that we have a much more bullish market on our hands than we've measured. And so key work for us here is don't get this wrong. And the conflict zone, the time to get this right isn't yet, but it's not far off. So for instance, if this is a wave 5 in the NASDAQ, then we should be rolling over in the 400s, maybe the 450, 460, something like that. If it's not rolling over there, there's a good chance this is wave 3. So the key work for us here is get this call right, because if one remains, bullish in anticipation of wave 3 here and it rolls over as a wave 5, you're going to get hurt badly. Equally, if you sell out of everything and start to go, well, if you sell out of everything, you're going to miss out on a whole lot of money here. And then worse, if you go short or God forbid, levered short here, you're going to be bleeding money while the market runs away from you, which is where, by the way, an awful lot of the market has been all year, because they just didn't believe this was going to happen. So this isn't today's problem for us, but it's a problem, I think, within a month or two to really start to get to grips with this. And there's not really any preparatory work, any science behind it. You just have to watch price. You have to be really open-minded and see what happens and see if the move up gets stuck at a particular, usually does get stuck at a particular fib if it can't move up above it, fibs being the language of large account players. And if it doesn't get stuck on those, then we recalibrate for the upside, which would be a high quality problem to have. So that, folks, is our index outlook. It's a long session, but it's really, really important to get this right. Now, most people will not believe that the markets are going to go this high, and maybe they don't. Maybe this is fantasy, garbage, nonsense. Of course, it could be, but you have to plan, right? We all plan for the downside. 2022 is fresh in everybody's memory. Everyone knows what that feels like. Everyone knows what to do. Cash up, go short, hedge, buy puts, something, right? That playbook is very familiar to all of us. Not many people are prepared for the market to move, which is another reason why it might. So if it does, we need to be ready for it. Okay, before we move on to Adobe earnings, anyone have any questions at all? Comments, questions, anything at all? Okay, no. Right, so let's do Adobe. Okay, so reported today, Adobe, you'll recall, essentially media software publisher, does lots and lots and lots of things now. It's online publishing, of course. It also has the Photoshop application, an extensive imaging library, an increasing amount of document handling, document management. It's increasingly competing with DocuSign, and where the company has been, really impressive in the last 10, even 20 years is every time something comes along to threaten it, it's pivoted, it's changed position, and it's survived. And so, 100 years ago, when those of us here are old, first knew Adobe, it was a desktop publishing business. So you would use it to prepare stuff that you then took to the printers to print for you. And it competed with Quark Express and things like that. Then Photoshop came along and you used it to manipulate photos and print them out. Well, that world changed, but Adobe managed to change with the world. And then what happened is subscription software came along. And Adobe used to be, you go to the store, you go to a big box retailer, and you'd buy a big shiny cellophane wrapped box of Adobe software, and it would cost you a big old chunk of change. And you would go home and install it on a CD, and blah blah blah, and then go and boil some gruel for dinner because microwaves hadn't been invented. Subscription software comes along. Adobe took the medicine, moved to a subscription model, and has come through that, brilliantly, just brilliantly. And right now, the company's products, I think, were looking a little bit old 18 months ago, but they've since replenished everything. They have something called the Creative Cloud, I think they called it. We subscribe to it, which includes all sorts of tools, really useful. They're in the process of trying to buy a business called Figma, which is a startup that competes in many aspects of Adobe. Good chance it gets struck down in antitrust, in my opinion, but it doesn't really matter. This is a $20 billion acquisition, hugely ambitious, designed to shore up their quasi-monopoly position. Company is super confident, for a big business to do that, to pay that size of a check for a company that had essentially no revenue. That's a confident management team. So this is a well-run business, I think. And if you look at the financials, absolutely rock solid. Now, we looked a moment ago at the fact that growth had sort of leveled out at this 10% level. They're forecasting 10% growth for next quarter at the midpoint. My guess is they beat that by a point or two. I think across the board, in the software companies we see, we're going to see an acceleration in revenue, partly because of the health of the economy, partly because it's getting easier. It's obviously easier to lap a 9 or a 10% quarter than it is a 14 or a 15 or a 20% quarter. So the weakness through 22 will help the comparative growth rates in 23 and 24. This quarter, gross margin, rock solid 88%. EBITDA margins 47%. Cash flow margins ticked up a point to 48, which is close to an all-time high. It hit 49 in May 21. So cash flow generation really excellent. Balance sheet safe as houses, just shy of $4 billion of net cash. And the other thing that's impressive at Adobe is the order book. So they don't have that much in the way of deferred revenue. That's in upfront invoiced contracts, but they have a big order book. And if you look, the order book's worth around 4/5 of trailing 12 months revenue, and that tells you that they've got plenty of visibility on how revenue is going to play out, and it's growing. The growth already accelerated in the order book. So growth flattened out in TTM revenue, 10% growth here last quarter, this quarter, and the forecast for next quarter. The order book RPO 10% in the February quarter, 10% in the May quarter, 11 in the August quarter. So that's a good piece of evidence that says we might see an improvement in revenue growth in the next quarter or two. Valuation, it's okay if you ask me as a buyer. The revenue multiple looks big, right? 13 times revenue for 10% growth. That seems big, but because the cash margins are so high, paying 27 times cash flow for this business doesn't seem so bad. If you look at Yimin's note on Google, published on Sunday, the argument with Google valuation is very similar, which is the revenue multiple for the growth looks a bit chunky and painful as a buyer, but the cash flow multiple doesn't at all. So you have to credit these companies that generate a wall of cash. You have to give them some credit for that, and you see that in the cash flow multiple. Low cash flow multiple for high cash flow margin business, lots of visibility on revenue. That's okay as a buyer. If we look at the Adobe chart, it's just had a huge run up. The dump last year was a combination of, old line enterprise software, which surely Adobe is, got hit quite hard last year. CRM, Salesforce had a pretty similar chart where it dumped many years of value. It dumped about 80% worth of, years and years of value built up, and CRM has started to recover. I don't think as strongly as Adobe, but and then the final insult to Adobe stock was this proposed Figma acquisition, which shareholders did not like one bit. I think shareholders are wrong, by the way, and I'm not an Adobe shareholder at this point, but for Adobe's sake, I hope that they get the deal through, because I think for them it's fantastic. I mean, probably the FTC's argument is correct. But if Adobe get it, then it's saying it's excellent news for Adobe shareholders to protect their market position. The stock reversed really hard in September last year. So if we go back to that 2018 low, we've got a 1, 2, 3, 4, 5 waves up. Perfect, picture perfect 5 waves up. So 78.6 wave 2 retrace into the COVID lows, a 1.618 wave 3 extension into the 2020 middle point, 38.2 retrace wave 4 low into March 21, and a wave 5 that peaked just above the 78.6 extension of wave 1 to 3 combined. Beautiful. You could teach that in chart school. And then we get, so we can call that a large degree wave 1 there, from the 2018 lows, to the 2021 highs. We then get slightly more than a 78.6 retrace off of that. So it dumped almost all the value in the course of November to September, 10 months that it had taken 3 years to build up. That's what a wave 2 looks like. Entered a wave 3 in September and has just been not quite only up, not NVIDIA only up, but it's been as you can see, a pretty joyous experience. We rate the stock at hold because the time to buy it, as we said at the time, was in the 270s to 310s, so just buying below that 78.6 retrace. So, if you caught it then, you're obviously in really, really good shape. If we were to zoom in and see what it looks like in the smaller degree, so this is the move up in Adobe from the September lows. That's right. So we get a wave 1 up, a 61.8 retrace wave 2. Again, really nice technicals. 1.618 wave 3 extension. And then the question I think is, is that a wave 3 high or not? It could be, but it's not much of a wave 4 down that, a 23.6% retrace. So yeah, that could be a 3 and a 4. We could be in a 5 here, in which case we should see this hit, 650 for the sake of argument. You could argue, I think, with some conviction that it's still in a wave 3. And if it's still in wave 3, we might yet see, 604 before a sell-off, and, maybe 652 before a sell-off, and then a wave 5 up. So it's not clear to me whether that spike high does kind of look like a wave 3 high, but the trouble is sell down after that is pretty shallow. It's slightly more than a 23.6 retrace, which is much of a wave 4. So I love this chart. I think if you said the stock could see 650 in the next couple of months, it's not a bad estimation. And if you thought about some sort of stop or support or something around 520, which is that wave 3 high here, or maybe below this 500, which is this retrace here, that's maybe okay. I think it's a challenging one to load up on now, just because it's had such a big run up. Zoom out again. All these stocks that we follow are smack in the middle of this markup zone. In my opinion, these are challenging to buy. If you hold them, then if you bought them down here, perfectly justifiable to take profits. I did this myself in MongoDB and Marvell and a bunch of others, and I'm happy I did so. 50% gains in no time at all in those names. Or you hold, for the big run up. It's quite challenging to buy here. I find it anyway. I personally would sooner look for other stocks that have yet to take off, which, for instance, if we were to look at Cloudflare for one, look where Cloudflare is, right? Still just about in our accumulation zone. And I think this one will take off. So I would find it personally easier to buy a Cloudflare than an Adobe. So we had a question in chat today about, is NVIDIA a good stock to buy? Well, can it run up? Yeah, sure, it can run up. This technical model says it could see 616, without too much technical stress. But, do you really feel like loading up after a run up like that? It's hard to get yourself over the hump to do that, for me anyway. Whereas, a stock that is still down here in accumulation, personally, I feel much easier buying. Zscaler is another one that looks a bit like Net. So it's starting to break out. But this is a slightly different chart to what we've looked at before with Zscaler. Again, we've called the COVID lows a wave 1 low. We've called that wave 1 high, huge wave 1, appropriately huge wave 2. If that's right, we're in a wave 3 now, and that can go all the way to the 600s. So I would find it easier to buy a Zscaler than I would an Nvidia or an Adobe personally, but that's just me. Okay, so that's Adobe earnings. Any questions on that one before we move on, folks? Got a couple of questions in the platform here. Hang on. Okay, Fahar. Okay, top stocks that are accumulating right now. As always, take a look at Stock Central. So I've mentioned two just now. That's Cloudflare, NET, and Zscaler, ZS. But look at Stock Central. We update that pretty regularly, and so take a look at that. And there are not so many rated at accumulate in tech right now because the time to be buying tech hand over fist was Q4 2022. That doesn't mean it can't go up. I think it can, but the time to really load the boat, and we said so at the time, was then. So in this rotation model, we look for this buy, accumulate, markup, distribute. We're always looking for, well, what's in that accumulation range? Those are the ones that we like to buy because it gives us just terrific risk reward. Stocks can fall down from the accumulation zone, but not that far the way we define them, and they can run up, but run up big. And so that's why so many of these tech names are at hold right now. It's not because they can't go up; it's that the risk reward is not as good as it was, 9 months ago or even 6 months ago. Okay, any more questions, folks, on Adobe or anything else before we move on? Julio, so in your analysis about whether, what the previous wave 5 was. No. Do you mean what did the cycle look like running into the 17 high? Is that what you mean, Julio? If you mean have we looked past?
Can you hear me?
Yeah, I can. Yeah.
Yeah, it's just like what the previous wave 5 wave cycle would have been to be able to know where that cycle ended and get an idea. Okay, this cycle that just started. If we're indeed in a wave, or getting to a wave 3, then the previous cycle might give some glimpses of where it ended.
Yeah, no, it's an excellent point, and we haven't done it. We should do it. And I had a similar question from another member on email earlier today, and so that's work that does need to be done. You're right, because if we're going to say, well, actually, that's not the right start point, you have to try to explain what went before. So it's a very good point, and we'll take a look at it. So I haven't done that work yet, but it's exactly the right question. Tom, you have a question?
Alex, hi. Could you quickly look at Qualcomm too? I know that one also went to accumulate.
Yeah, Qualcomm's in good shape. Qualcomm's in good shape. I think we're at accumulate on Qualcomm. We should be anyway. Yeah, there you go. Yeah, Qualcomm's in really good shape, I think. So here we go. So track back to the 2018 lows. Again, a great chart. Really, really nice technical chart. 1 up, 2 down, 78.6 retrace, 2.236 wave 3 up, 38.2 wave 4 down, 61.8. I mean, just, thing of beauty, right? So the wave 5 terminates exactly where it's supposed to. So does the wave 3, so does the 4, so does the 2. And so that 5 waves up cycle, one feels absolutely great about that. So it's a bigger wave 1 up, and then at the wave 2 down, larger degree, troughs down to the 61.8 retrace of that move up. So that's a pretty good wave 2. And then it's just sort of meandering along. It's in this accumulation zone now. So yeah, I think Qualcomm looks good. And I think this can be in a wave 3 up now. And the catalyst obviously is the renewed or extended Apple contract, which is probably the news that folks who are accumulating here sort of knew was going to happen, because it probably isn't too much of a secret in Apple that their modem work is delayed. So that would probably explain why the stock is sort of sideways for the last year or so. But yeah, I think Qualcomm can move up. So we should be at accumulate.
Thank you.
Welcome. Qualcomm fundamentals, by the way, are not pretty. It's a really seriously lumpy business. It's had some major revenue declines in recent quarters, but as a result, if that renewed Apple, that extended Apple contract, if that starts to flow into fundamentals next quarter or two, then we'll see a rapid upswing in the fundamentals, which will then the news will tell you is why the stock then moved up. But that's not why the stock moved up. The stock will have moved up because folks who have known what's going on in Apple will have known that their modem efforts are robust or delayed, and will have been accumulating Qualcomm as a result in anticipation of that move. And then that will be subsequently justified as, oh, well, they printed a great quarter in 2 or 3 quarters' time. But no, Qualcomm looks good, I think. I've been thinking about buying back into it. I haven't done that yet, but I've been thinking about it. Who's next? Jake. Jake, if you can hear me, you're on. Okay. Okay, Jake, if you can't use audio for any reason, use the chat box in the webinar system or use the regular Growth Investor Pro chat room. So I'll look out for your question there. Okay, Jake's typing. Hold on. Okay, while you're typing, Jake, we're going to just call up the uranium ETFs to get ready to go through those. Okay, good, great question. Okay, so Jake's question is, and I'm going to call the charts up for this, what's the catalyst on Zscaler and Cloudflare? Well, let's look at Zscaler first. Okay, I think the catalyst for this thing is really simple, which is, cybersecurity is only going to become an increasingly problematic area. And you see me say many times, it's not really an opinion, it's just sort of statement of fact, that what happens in tech is that the lowest cost acceptable solution always wins. Let me give you a worked example of this. Okay, go and drive on an Autobahn in Germany, and most of the Autobahns there are incredible surfaces where the tarmac is brand new, it's metalled, it's grippy, the camber is correct on bends, the Armco barriers are all in place, the service stations are polished steel. It's a thing of great beauty, exceptionally expensive, but just a perfect driving experience. And now go and drive on the 280 freeway in California, which is held together by string. The surface is pretty awful. The camber is pretty good, where the original race car driver curves are still in place, but where repairs have been made, the camber can throw you off. And if you're driving in, something with truck-like suspension, you can have some pretty hairy moments at anything over, 60 odd miles an hour. Well, in tech, the product that always wins is the 280 freeway, because it gets you there and it didn't cost you anything much. And enterprise customers will never keep buying the Autobahn if they can buy a 280. And so the Autobahn in cybersecurity is endpoint protection, hardware-based devices, Cisco VPNs, all of that. Things of technical beauty, operating at line speed frequently, superb technology. But it's really expensive. It's hard to configure. It's hard to reconfigure. Every time you want to do a move, add, or a change, you've got to pay someone a fortune, be it your own internal engineers or a Cisco engineer, or you've got to buy a whole new Palo Alto subscription or a line card or something. It's a nightmare. That's the Autobahn. The 280 freeway in cybersecurity is Zscaler, and in particular, actually, if they get their act together, it's Cloudflare, which is cheaper and will sell you a bundled solution of a zero trust network, application acceleration, content delivery, all of that. application development environment, a bunch of other things. And so the catalyst here is that the move to in-network security, I think, is a cheaper way for enterprises to configure security than trying to frantically run around protecting every network node and endpoint. It's much cheaper to put a zero trust perimeter around and say, well, any incoming node, any incoming device, identity, whatever it might be, we don't trust it until proven otherwise, and that's a network solution. So that's what Zscaler does, as you know. They innovated that sector, initially made it their own. There's multiple people doing zero trust now. Cloudflare's the challenger, and so I think the catalyst is cybersecurity, of ever increasing importance, and enterprises finding a 283-way type solution, which is just good enough, but an awful lot cheaper than any sort of hardware-based or endpoint-based answer. And there's some really interesting comments in chat this week from username Millennial Tyler, probably not his real name, who's a cybersecurity professional, and he made some commentary in the air about he felt it was likely that cybersecurity insurance would start to require zero trust type solutions. Now that's not an overnight development. That's not suddenly enterprises and federal government departments have to have this stuff. But he felt that the direction of travel is you're going to have to evidence that you've taken cybersecurity precautions with this zero trust perimeter, and anything like that can really start to accelerate adoption of the Zscaler or the Cloudflare architecture. Now, designing, installing, implementing these solutions, that's a long sales cycle, multi-month, possibly multi-year sales cycle. It's probably multi-month, multi-year to install. Ask Millennial Tyler about that. Nothing happens quickly in this world, but I would see this as a gradual shift to, just good enough quality in network, so it's cheap, and then external factors like, insurance requirements pushing enterprises towards this. So that's my external answer. What will really push these names into market? My answer is these things have been under accumulation. I'm sure of it. Net and Zscaler alike, and pretty soon I would expect to see lots of excitement about those stocks. So I saw one service that I watch, stock service that I watch, who basically scans, what is it, Investors Business Daily, and one or two other things for hot stocks. I saw Cloudflare mentioned there. That's not a tech focused service at all, but that's someone going, IBD is saying this thing's going to move up. And so once you start to see these things a little bit more mainstream, you're going to be a markup quite soon, because that's when late money comes in. If you've been buying net, let's get the net chart up here. If you've been diligently accumulating net for the last year at between 36 and $65 a share, then you're probably not going to get excited about it $100 a share because you've been buying it already. But once it starts to move up here, when it's at 130, the CEO will be on CNBC in his big fisherman's jumper telling us all about the future, and then some more people will pile in. This is the late money zone, right? And so once you start to see other people go, Cloudflare's hot stock, you're probably going to be a markup soon, because it's not an accident that people are jumping up and down, starting to get excited about it. People are doing that because big money's been accumulating it for a year or so. Zscaler, let's just take a look at that one. Just put the volume chart on. Same story, I think. Yeah, look at that. So that's the volume chart that starts at the all-time high here. Just look between these two. As if by magic, right? So between the 78.6 and the 61.8 retrace, shocker, you've got this huge accumulation here, which would have started back in May last year. So you've had, more than a year of accumulation here. So you can bet you're going to see some good news stories about Zscaler soon. And we need to redraw our stock central chart a bit. I'd probably have this as accumulate all the way up to this 165, and then if it breaks up and over here, we're into these low volume nodes. I think it can rip up through here because there's not much overhead supply. You don't have much pent up frustrated bag holders up here relative to the supply that's been bought down here. So that's a long answer, but yeah, that's my answer. Sorry for a long answer.
Can you hear me now?
Yeah.
Okay, cool. Yeah, just I don't want to take up too much time on this, but the question you just kind of got into was overhead supply, and I have some stocks that are not these. They're not even covered, but they have no overhead supply because they've simply never reached the height that they're going to.
Right.
In that kind of scenario, how and I want to recycle my cash into these opportunities, but so I'm going to have to sell and trim some stuff, and I'm just wondering,
Right.
in a scenario like that, how do I know when
Well, you
to?
measure it. So give me a
Um,
stock, and we'll do it live.
okay, this one's not covered in the service. It's called Hudson, HDSN.
What did it do?
Hmm.
Hey, Jake, what does the company do?
Oh, they're a like refrigerant reconditioning. I think they recondition like supply of refrigerants. Um,
Okay.
there's a sustainability act called the AIM Act that's forcing companies to be able to have more sustainable forms of refrigerant
Yeah,
um,
makes sense.
for their
Okay.
cooling devices.
Okay, so let's take a look. Right. I don't know,
So
as you can tell,
they
I know
produce
nothing
them.
about the business. Okay, so there you've got, a long-term multi-year low, right? So back to November 2002. Has this had a stock split, or is it just a low price? There's no split. Okay. So you've got support at 50 cents, let's say, fundamental support. Okay, and then you got this big move up from here. So we'd have to call that a low, right? So let's have a look. Let's go to the weekly. This is what you use fibs for, right? So to measure moves, so that you're not trying to guess. This is what I use them for anyway. So let's just switch the volume off a minute. So what I would do here, it might not work on this stock, is I would look first of all for a wave 2 down. I mean, the thing is, it hasn't really had one. Let's call that a wave 2 for the sake of argument. 38.2 retrace, not much. Okay. And then I would look for what's my wave 3 up. I will say this chart method works better with really liquid stocks. And if this is a sub $10 stock, it probably isn't all that liquid, but nonetheless, let's have a go. Okay, so if I had to take a wild guess, I've never heard of the company before, I've never looked at the chart before. A wild guess would be something like this, right? Okay, so let's just measure that retrace. I'm not thrilled about doing this with relatively illiquid stocks. I've found that it doesn't work that well with that, but let's have a go. Okay, TrendSpider has this really annoying error sometimes. Okay, look. Okay, if I was to guess, if this system holds true, then you might see a peak in that stock somewhere between 15 and 17. And the logic for that is really simple, which is it's not a great chart, this. So you've got, in my opinion, probably too shallow a wave 2 there, but I can't find another wave 2. Wave 3 looks okay, 4 looks okay, 50% retracement, that's all right. And then wave 5s usually peak between the 61.8 and the 78.6 extension of the 1 to 3 combined. which will be between 15 and 17 bucks a share, something like that. So if this pattern works out, and I would put extreme caution around this on illiquid stocks, because again, this has tripped me up before on these smaller names, then, if you were taking profits in that 15 to 17 zone, it wouldn't surprise me if you were to see the stock roll over at that point. But, again, you have to do this work yourself, right? I don't know the stock, and I'm uncomfortable doing this with illiquid names. You can see which stocks are actively run to this fib and wave method when you do the charts, because they fit perfectly. You saw that with Qualcomm a moment ago, where literally to the dollar it fits, and that can't possibly be an accident. It can only be because they run that way. And so when you have to shoehorn stocks into this system, it sort of makes you feel like, okay, I've probably got the wrong chart method here for this stock. So I feel a bit uncomfortable about this, but it looks like it's in a wave 5 high of a run up from the September 19 lows. That's what it looks like. You could, I think, just get rid of this. Hang on. You probably could make an argument, just get rid of all this. I think you can make an argument that the stock, let's have a look. Yeah, I can't find a great wave 2, to be honest, and so I'm struggling a bit with that one. But best guess, it's in a wave 5 up, 15 to 17. It might roll over. So come back to you in a week or two and tell me how that works out. That's my best guess.
Yeah, thank you.
But the general answer is measure it, right? The number one thing, the reason that I got into technical analysis, and by training I'm a fundamentalist, right? I spent decades as an institutional investor, venture capital, then leverage buyouts. Leverage buyouts are all about fundamentals, deep fundamentals, right? What's this week's cash flow going to be? And technical analysis I got into because I couldn't answer exactly the question that you just asked, which is, where should I sell? Now, we can all look at a big dump in a stock and say, well, that's oversold, right? Because we can all say, well, revenue looks all right, earnings are growing, balance sheet looks okay, the stock's just sold off 20% for no reason at all, I'll probably buy that. We can all come to that conclusion ourselves. And as we get better at this chart method, we get better at calling, well, is that a buyable dip or not? And should I wait? And all of that. But the instinct of that's oversold, I can buy that. Most of us can develop that quite quickly. The thing I could never work out until I found this fib method is, where'd you sell? Because holding forever is a recipe for someone to take your money off of you. Selling when everything moves up 10% is a recipe to surrender lots of profits. And I couldn't ever work out the answer. PE ratios don't do it for you. And why I came to technical analysis was I read a tiny little book called Tramline Trading. It's only about 100 pages, written by an aging Englishman, that basically talked a little bit about parallel trading channels and a little bit about fib extensions, and that got me hooked because I could measure it. And so I could measure something that said, this is getting a bit stretched, this is moving up a bit far, it's in the final move of the 5-wave cycle, it's hit those fib extensions, I think I'll take the money out. And so personally, since I've started doing that, one, if I take profits and I'm wrong and it keeps running up, I don't care, right? I will have banked a solid gain, sold it for good reasons, and I just never look back. I don't look in the rear view. It doesn't matter. Go and find something else more interesting instead. And secondly, very often it'll turn out, if not correct to the dollar, then not far off. So I'll give you Iridium as a good example. This is one that we went to distribute on last year. And again, just look at the chart here. I mentioned earlier, you can spot stocks that are run to fibs and waves. I mean, look at this thing, right? So this is 2017 lows, wave 1 up, 61.8 retraced down into the COVID lows, 1.618 extension into the 2021 highs, 61.8 retraced the wave 4 low that is exactly to the dollar, the wave 1 high, right? Not an accident. And then a wave 5 that peaks precisely to the cent at the 78.6 extension of the wave 1 to 3 combined place the wave 4 low, right? That's not, it's not a freak of nature. That stock is run that way. And so I sold in the 50s from memory because I figured, it's getting a bit toppy and I fancy rotating the capital. This was, late last year. I wanted to rotate the capital into some growth stocks that were all beaten up, so that worked out nicely for me. I could have held a bit longer, but then I would have missed the opportunity to buy the growth stocks at dirt cheap prices. It's in markdown now. You can see that vertiginous drop. No buyers, no volume buyers. Looks like it's slowing down. Maybe that's the start of an A, B, C, something like that. Maybe. So I've sort of been thinking about, do I want to buy this for a run up in the B and then get out before the C and then start a long-term position again? But you can measure these things, and so my life got a lot less stressful with stocks, and my investing became a lot more successful once I learned to do these rotations based on measuring the moves as opposed to guessing the moves. Again, stock dumps for no reason at all. There's the COVID lows. Nancy Pelosi comes on television, says, there's a floor under the market. Off we go. We can all buy that. That's not so hard. But calling the tops of the waves, you need a method to that. You need to measure it. So you need to find a method that works for you.
Thank you.
Welcome. All right. We better move on. Okay, so we're at time, but let's very quickly do. Okay, so someone in the WPS in chat says the name of the author on Trent. It's called Tramline Trading. TRAM, Tramline Trading. First name John, can't remember his surname. I'll try and find it. I'll post it in chat later on. It's really, really good. It's simple. Anyone can read it. I mean, I read it when I knew nothing about technical analysis. Is that it?
Okay,
Yeah,
thanks. I thought you had said Trendline Trading.
No. So, Jake just posted it in chat. That's it. Tramline Trading. That's the one.
Awesome. Thank you.
Yeah, it's really, really, really good. And I read it 10 times over. And sat with it at my desk for months on end. It's really, really good. It's really basic. When you start to read it, you'll be like, oh, this is for children. But that's what you want. You want to start with that and then go on from that. And, you can read tons more sophisticated things after that, but that's the one that got me started. Okay, let's just quickly do uranium. So uranium has been on fire. Hang on a second. So there's 3 we covered, but let's just pick 2. So this is the spot fund. This is U.UN, which is the native Canadian fund, and SRWF is the ADR equivalent. Let's use U.UN. This is priced in Canadian dollars, but again, chart doesn't matter. Okay, again, right? This thing trades the fibs and waves, right? So this is COVID low here, wave 1 up, 61.8 retrace, wave 2 down. Wave 3 up doesn't quite make the 2.618 extension. Wave 4 down, which is nearly a 61.8 retrace, again starts to threaten that wave 1 high, and a wave 5 up just there. That's the larger group wave 1. Sells down to almost exactly the 61.8 retrace of that 1 up. There you go, it's wave 2 low, and now we're in a wave 3. And now what we'd said, if you look at the charts, we'd said chicken bull target $20. In other words, if your nerve didn't hold, sell at $20. The reasonable bull target, if you have a little bit of faith in these fibs, $26. We're not there yet now, but look at the stock. That's in direct ascent. And the reason it's in direct ascent, I can't show it on here easily. Maybe I can. Yeah, okay, that's why it's in direct ascent. There's no volume. I mean, to your point earlier, Jake, this is at an all-time high, so there is no overhead supply. And that's why stocks at an all-time high can keep moving up. And that befuddles you when you think about it, because it's at an all-time high. Who's buying this thing? But that's not really the answer. The answer is there isn't any supply of sales in any volume from people who are glad to be out of it. And so there's not that much supply. There's lots of demand to chase momentum. And so of course price moves up. I mean, look at this thing. It's vertical. So where can U.UN go to? There you go. Reasonable bull target. So it's past the chicken bull target, $20. This is the same charts in Stock Central, by the way. Reasonable bull target, $26. That's the 100% extension of this wave 1 placed at the wave 2 low. Crazy rodeo bull target, but it's not really crazy. It's the standard wave 3 extension, $34. And again, that looks crazy from here, right? So it's vertically up. It's at $22. And 26 looks like a stretch and 34 looks insane, but it's not insane. That's what a wave 3 looks like. So I don't know if we'll get there, but there's nothing in that chart that looks unreasonable to me. URNN, let's take a look at that one. We've got that in TrendSpider, hold on. There you go, same thing, right? Vertical launch. This, let's have a look. Yeah, similar story. Okay, so this is COVID lows, 1, 2, 3, 4, 5 waves up. Bit trickier to trade this one looking at it, but the 1 up is righteous, the 2 down is righteous, so it troughs between the 0.5 and the 61.8 retrace. A lot of sideways action here. We're going to accumulate between 27 and 35 we had it at, and we'd said, we've set a markup zone here to be up to the last all-time high, but really and truly minimum wave 3 probably is the 100% extension at $70 a share, and again you could see it get to 97 just on standard technical logic. So URNM looking pretty good. The thing that personally always spooks me about uranium stocks and causes me to always take profits early, and I don't mind doing that, is the singularity event. It's not wonderful that you've got Russia constantly shelling the Zaporizhia nuclear plant and turning off the cold water supply and all of that. It doesn't fill me with joy about uranium stocks, because you only need a catastrophic event there to send the stocks plummeting, even though it's nothing to do with the supply or price of uranium. So I'm always personally a bit hesitant to commit a ton of capital to these things. I've made really, really good returns on various uranium stocks in the last couple of years, but I've tended to be in and out, because I just don't want to be holding big exposure, particularly right now when the Zaporizhia plant is basically very quietly a weaponized Chernobyl that I'm sure will be brought to bear as leverage at some point on the West. Hasn't happened yet, but that's my expectation of what happens there. So personally, I'm a bit nervous of holding big positions in uranium, but as a place to trade profits, it's been a wonderful market for me personally. But absent Zaporizhia being turned into a great big bargaining chip for Ukrainian land, which is what I expect to happen, URNM can make $97, and U.UN or SRUF, U.UN, easily $26 and quite possibly $34. So there's plenty to run yet, I guess. Okay, last thing. We're over time, so let's just do this real quick. I just want to look at a couple more things we're just going to introduce into the service soon. 1 second. Okay. We were going to do some fundamentals today, which is going to have to wait. So we've done uranium. Okay, we're going to have some more semiconductor coverage coming into the service. So ARM, the IPO today, we'll cover. We're not going to be going to buy on that anytime soon. Let's just let the dust settle and see where it lands. But we'll cover the stock for sure. Critically important business to the semiconductor and the electronic sector. We will soon, I hope, be having coverage of ASML and LRCX. Those are two of the semiconductor capital equipment businesses, critically important, big businesses, good stocks. And then Cadence and Synopsys, which are software businesses, but they sell design software that's used for exclusive in the semiconductor industry. So we'll be introducing Cadence and Synopsys within the next couple of weeks. I hope ASML and LRCX in the same time frame, but we'll see. And ARM over the next 2, 3, 4 weeks. There's no hurry on ARM. Again, I personally don't feel in the rush to buy it, but I'm sure it'll be an ARM shareholder at some point. But yeah, let's let the IPO dust settle first. The other thing I want to bring to folks' attention is there is a feature in the service that you can all access. It's a bit difficult to get to because of the way Seeking Alpha has set it up, but we run a really basic version of a service on Seeking Alpha. It's a couple $100 a year, $99 for the first year, $200 for the second. And it's just a swing trade service. It's called the basic tier. And it's nothing very exciting, but what it does is it looks for 10 to 20% absolute gains in a quick turn manner amongst the stocks that we cover in the full service. And this is the returns as of a few days ago. The top section, closed picks, that's where we've called a buy and called a sell, closed them out. All positive gains, as you can see. Worst one was 9.3% absolute gain and 33% IRR, and the best one was 22% absolute and 255% IRR. So these are basically quick swing trades. The table below is open picks. In other words, we've called a buy, we've yet to call a sell. Some of them are, quite painfully underwater. DocuSign, actually no, Spire is the worst, 24% under. Some of them are starting to make money. Microsoft, Datadog, and then you can access this. I wish that you got alerts of this in an automated fashion. The Seeking Alpha system doesn't allow this, but I will try and do an at-all alert in chat so that you at least see the articles when they're published. But so you all can access this. It's just difficult to find it. So I'll probably do this through chat so that at least you can see when the buys and the sells are called. The articles are short. You get far more in the service you will pay for. You pay for a much more expensive service, so you don't learn anything from the articles. But the swing trade buys and sells, I think, would be interesting to some people. The whole notion with this service, you run this on a different basis to the main service. This is an IRR maximization service. So the idea with this here is get in, get out quickly, to rotate capital quickly. If you were to run your account on this basis and you were to run a sort of a project IRR on this, you'd find that it's a pretty good way to run an account. So I'll try and make that easier for folks to find. I wish the Seeking Alpha system was more flexible, but it isn't. Okay, so that's all I've got for today, folks. I've got one question queued up, I think. Preston, you have a question?
Yeah, hey, thanks, Alex. Real quick on the basic trades, the IRR calc, you don't need to go into the exact thing, but is that more or less like an annualized look at the, okay.
Yeah, it's exactly that.
Got it. Okay.
Yeah, so I mean, it obviously gets a bit silly. So if you hold, there's Taiwan Semiconductor here that was, 16% in 8 days, which annualizes 111,000%. I mean, it's a bit silly. Of course, you're not going to achieve 111,000% holding that for a year. So it's exaggerated the upside. But the point to include it is that it's supposed to be a quick turn money service. Because obviously, if you can chalk up 16% in 8 days and then do something else with the capital, that's pretty good.
Yeah, I mean, I'll just say for myself. I mean, I started with you guys on the basic service, and I had decent, not even call it luck with it. I mean, that almost feels to me like a good way to run what we're in now. But I guess obviously the GIP provides more information, but I guess question, the picks that you make in the GIP aren't always the same as the basic. Is the theory similar as far as the, IRR approach in the GIP, or would you say it's more of a longer term? Yeah.
Yeah, GIP is meant to be longer term. So the way we do this, if we have a pick in the basic tier, the minute it's at 10%, I start to get itchy and I start to think about closing it out.
Got it.
And it takes me, I really have to hold my nerve to ride it up to 20% in that service, because that's not the idea. The idea is basically what we're trying to offer is folks who, are very often relatively new to this kind of thing. I don't want to be providing any super risky ideas that involves averaging down. And the other thing is Seeking Alpha require a performance tracker on that tier. But what they don't enable is, buying in tranches, selling bits, hedging, shorting, puts. The system isn't that complicated. You can buy it once, you can sell it once, and so that kind of drove the service idea, and it turned into quite a good service. But it came out of frustration with a simple setup, and so I figured, okay, if we've got a simple setup, then we'll just offer simple buy, simple sell, in, out, get your money out quickly. And
right.
It's obviously been a very fortunate run. I mean, it's not normal to have them all green like that. We've just been lucky.
Yeah.
But
Well, I
no,
mean,
it's
even the way you guys
supposed
set
to
it
be
up
quicker.
with the accumulate, markup distribute model. I mean, I followed that with the basic, and I mean, I would make multiple buys, not just a one-time buy, but
Yeah.
anyway, I know that's what obviously got me into the GIP. But
Well, that's
thank
great.
you
Look,
for that.
you're
Yeah.
welcome. We've got a ton of subscribers, and we've got thousands of paying members in that service, and a lot of them do better than the service because they don't quit out at the 10%, 15% gain, and that's great.
Hmm.
But the point of the service is low risk, not trying to swing for the fences, just go to work, chop wood, get some money, come home. That's the idea.
Yep.
So anyway,
Alex,
I'll go ahead.
no, I was gonna ask. So you said announcements about this don't come through Seeking Alpha. So how do you broadcast like when you're doing the buys and the sells?
Yeah, they come through Seeking Alpha for basic subscribers, but unfortunately, what would be really nice is to be able to configure the alerts so that whether you're a basic or you're a full service subscriber, you get the alerts. That's what I would like, because this is just extra. So for instance, if you are following Zscaler on a long-term pattern, why wouldn't you also try and score a 10% here, a 15% there,
Yeah.
in a different account or with a different piece of capital in the same account? Why would you not want to do that? And so I wish that the alerts came through to full subscribers. That they don't. The system isn't configured like that yet. They're working on it, and I hope it will be one day, but it isn't right now. So no, it does come through Seeking Alpha, but the minute you become a full service subscriber, you don't get the alerts. And so what I'm saying is, look, we'll try and do this through an at-all chat alert, just as a workaround,
Yeah.
because
I was gonna ask about that. Like, yeah, maybe through your Slack channels or through the existing Rocket
no, it
channel
gets no. We
alerts,
want no. It's too
logistics.
It's too confusing because Seeking Alpha on the Seeking Alpha services, they control all the billing and the subscriber management, all of that. We pay them a hefty pay away, a big pay away. But in exchange, what we get is we don't bill anybody. We don't have to handle any billing question support, expiry, any of that. They do all that. But trying to integrate that subscriber database with ours would be a nightmare and it would go wrong. So no, it's got to be within the Seeking Alpha system.
Got it. Okay.
We'll do it through an at-all chat. Right, folks, I have to go. I've got another call shortly. We're 20 minutes over. So let's wrap it up. Any more questions that I haven't answered, please post them in chat. I'll get to them later on today. But we have to wrap up now. So look, thanks everybody for attending tonight. Another good webinar. A lot of fun to do these. Love talking to you guys. The questions and points that you raise are always super, super good, and always result. You probably don't realize this, but always result in some improvement or other to the service, be what we do or the way we do it, or what we think about it. So please always, one, show up to the webinars, and two, always ask questions. Doesn't matter how dumb a question you think it is. I can guarantee you it's not a dumb question, and always there's a service improvement afterwards. So thanks everyone for being a member here. Service continues to grow, just great. Whole business is growing like a weed. That's not normal in our industry right now. We grew all the way through a terrible bear market in 22. We've been on fire in 23, and that's thanks to you guys. So much appreciated for your business, and long may it continue. So we look forward to seeing you in chat later on. Any questions I haven't answered, put them in chat and we'll get to them in an hour or two. Thanks everyone, and talk to you all soon.